Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. This is our new series, LPAC, where we bring on previous guests on the podcast to answer your questions on how to build your venture fund. If you're a fund manager and need advice, you can submit your questions to me at cupofjoe.com/contact. That's cupofzhou.com/contact. And maybe we'll have you on the show next. So today we've got a good friend of mine, as well as good friend of the show, John Felix at Pattern Ventures. He's got capital allocator running through his blood since he first started from multiple endowments to Allocate to now Pattern. If you want to hear more about how he thinks about investing in venture, I'd highly recommend you checking out Season 3, Episode 1, which we'll link in the show notes below. So not to dilly-dally any longer, John Felix. John, good to have you back. Good to have you back. We're in Season 5 now. And we had you Season 3, Episode 1. And you were the first person I remember who gave us B-roll. And for those who have frequent flyer miles on Superclusters, they probably still remember you being on stage and playing that guitar.
You really dug through the archives to find that. It was impressive.
It was fun. It was really, really fun. And I think that's what made this episode even more special, on top of all the insight in which you have shared. But we have you again. And this time, you're not at Allocate anymore. So a couple things have changed since the last time we chatted. You're now co-running Pattern Ventures. You moved to New York. And I feel kind of bad because you betrayed me, because we were out here in San Francisco. We were having a good thing going. And then you were like, you know what? I'm going to move back closer to home, New York. So you moved to New York. You got married. And I know I say this a lot in our regular catch-ups, but huge congrats again.
Thank you.
And you also brought in a new member to the family, a Boston Terrier named Larry. But there's one thing that hasn't changed, if I remember correctly. And I hope I remember correctly. You're still focused on backing great emerging managers. But in between in all this, are there any other chapters I may have missed?
Yeah, that's a lot. That's a lot of change for a year, David. Getting married, moving across the country, getting a dog, new job. Look, there's always, I think there's always many chapters, but I really thought of last year as the year of change in my life, closing a lot of amazing chapters, opening a lot of new ones. Obviously, marrying my life partner, was an amazing, momentous occasion in my life, and then welcoming Larry to our family was something that we had talked about wanting a dog for a while, and I think we both. My wife runs a startup. We're both kind of doing the entrepreneurial thing, and we both just always made excuses of why now is not the right time. And in life, it's always easy to justify why now is not the right time to do something, right? But I think it's hard to justify why now is the right time to do something. But Larry kind of fell into our laps and has just been an absolute joy and complete welcome addition to our lives. And he's just made everything better. And if you don't have having a dog really just makes everything better. Coming home at the end of the day, their unconditional loyalty and happiness and love. And Larry is full of love. He loves people. He's a little needy. He loves attention. He doesn't know the first thing about personal space.
I love it.
But that's okay.
So now you're at Pattern, and I know we haven't gotten the full deep dive on Pattern at a high level, because last time we had you introduce Allocate. How would you describe Pattern?
We are a specialized fund of funds, and our focus is on a category of fund sizes. So we primarily focus on backing managers that are raising funds 50 million or below. A lot of those managers are emerging, but some of them are not. We don't really lead with categorizing ourselves as an emerging manager fund of funds, because we're happy to back any fund number that's kept their fund size below 50. We backed a fund 7 recently, who's below 50 and just has recognized the power of staying small and generating great returns over time. I wish we could find more of those folks. A lot of people that have early success in their fund 1s or fund 2s or fund 3s do tend to scale AUM, and we will follow on with funds that scale beyond 50 to the extent that we think their strategy remains effective and they can still generate really competitive returns. But yeah, we're really focused on this small part of the ecosystem. And I think it's emblematic of how venture has changed, where in my mind, venture is becoming more barbelled, where on one end of the spectrum, you have these massive incumbent multi-stage firms, these, the firms that we all think of as the brand name firms, that have these massive funds, these deep pockets, can fund a company from inception to IPO and beyond. And then on the other side of the spectrum, you have these small funds who don't have to be competitive. They can get small checks into good deals. And those small checks and the small ownership that they're getting, it still makes sense for their fund size, right? And the math still makes sense. And so I think venture is becoming more bifurcated in that way. I think the middle zone is becoming really tougher to play in. And so when we thought about, where can we generate the best absolute returns in venture going forward, where's the highest upside potential, this is the part of the market that we chose to focus on.
Is there a reason? And I've heard many versions of this from other fund of funds where the cutoff sometimes is 75, it's 80, it's 100. Is there a rhyme and reason to why Pattern's cutoff is 50?
Yeah, there is. And we wrote a really great white paper on this called Access and Outliers. But we looked at every 5x net DPI fund going back 50 years. And the largest cohort of those funds is in the $50 million and below fund size. And so we said, let's just draw a line in the sand there, really be laser focused on owning this part of the ecosystem, be laser focused on generating absolute returns that are really strong. And so, that's where we decided to focus. And I can share the paper that we wrote, but it goes into a lot more detail on the research behind it and the data behind it. There's also just a lot of noise in the $50 to $100 million range and beyond. And we want to remain really focused, and drawing a line in the sand at 50 allows us to be really focused and quarter this end of the market.
How do you define noise? Because to many others, they might feel like there's a lot of emerging managers, fund ones and fund twos, who are sub 50, and everyone's coming out of the woodwork. They're spinouts, they're operators turning into VCs. Like, they might define that as noise. How would you define noise?
It's a good question. The first thing I'd say is I think about everything in terms of how I spend my time, right? And I think a lot of us that work in tech and venture are always trying to hack or try to figure out how to more efficiently spend our time. And when you go above 50, especially once you hit 100 million, 100 million is a number that a lot of GPs have in their head. It's kind of like this magic number, right? I want to raise an $100 million fund at some point. And I think at that point, a lot of that's just driven by ego or hubris, or wanting to say that you raised an $100 million fund.
Right.
And I think that creates a lot of noise in that cohort. So we just think a lot about how we want to spend our time, how to remain really focused. I'm a big believer in doing fewer things better rather than trying to do more things less well. And so drawing a line in the sand at 50, like I said, it allows us to just remain really, really, really focused on one part of the ecosystem. That, by the way, we think is a really attractive part of the ecosystem if we can pick the right managers, which I think, selfishly, I think we can do.
I've heard some of this dialogue where there are some funds who are investing in niche industries, where the truth is they come in at pre-seed seed, but there's really no Series A player that can lead around and can inject that company with capital. And so far, just because of how niche, deep tech, you name it, whatever it is, that the company's at, there is no immediate kind of cash injection, which means they can't get to profitability. And whether it's hard tech or life sciences or energy, they struggle. And so part of that is they need to raise larger funds. Obviously, if you're investing in enterprise AI, for example, there is so much capital downstream, you really don't need to go past 50 because you don't need to save reserves for any of your portfolio companies. What are your thoughts around that?
So it's a great question, and it's something that we think a lot about. And one area where we've spent a lot of time looking at managers and meeting with managers, but haven't really done anything, is biotech and deep life sciences, because I think there is a lot of financing risk for these companies. They need plenty of financing rounds. Oftentimes, IPOs are not really exit events; they're really just they're really financing events.
Yeah.
And so We haven't really done a dedicated bio manager because of that. It's a space that we like a lot, but I think you need a little bit of a bigger fund size to mitigate the financing risk, to keep these companies going and get them to profitability. And so we think a lot about the financing risk, right? Like, and another way to kind of look at this is we love investing in things that are contrarian or not consensus, but there has to be a path to becoming consensus, because something can't remain non-consensus forever. There has to be a catalyst that the market eventually realizes this, or else the company is not going to be able to raise downstream capital. It's not going to be able to sustain and continue to grow and survive. And so this is something that we think a lot about. We tend to back more generalist firms than we do really niche specific thematic driven firms. We're open to backing those type of firms, but it's a higher bar. And I think you're in a way taking more risk because you're kind of making a timing bet. You're kind of making a market bet. And we would rather just back exceptional people who we think are going to back the best, the most exceptional opportunities they see at any given time.
How do you think about portfolio overlap? In the sense that if you invest in enough generalist funds who may or may not share deal flow, there comes to a point when, let's say, you have 500 underlying or like 600 underlying portfolio companies, you'll have, 5, 10% overlap with each other because everyone's in the same deal flow, everyone's participating in the same things. How do you think about that?
Overlap's a good thing if the companies are great.
True.
Right? But obviously, if the companies are not good, it's a bad thing. So I don't think overlap is inherently a bad thing. It does add another dimension of risk to your portfolio. And so the way I think about, maybe I'll say diversification rather than overlap, is we manage diversification somewhat passively. So we don't set targets like we need X amount of exposure to enterprise software. We need X amount of exposure to consumer, right? But we're also not going to go out and back 20 funds all doing the same thing.
Totally.
And so, we manage that diversification kind of passively to an extent, somewhat actively a little bit, but it's really an output more than an input. And some of our managers are going to have overlap, and we're okay with that. And hopefully those are great companies that we just have double the exposure to, and they do really well.
Fair point. I imagine you're probably not investing in that many funds who are all telling you they source from YC Demo Day.
Correct.
There's too much overlap there, or there's too much potential for overlap because you are investing in. Yeah. I love this line that Adam Marchik, who's at Acadian now, once said. It's like you're investing in a blind pool of human potential, and there's too much potential overlap in that blind pool.
Yes. Yeah. Agreed. And we think a lot about actually one way that we think a lot about overlap and diversification is less even about the end sector or theme and more about networks, right? And so if somebody, if two managers are sourcing from the same network, even if they might be sourcing different companies or different, end sectors, that's still a form of overlap, right? And I think YC is a good example of that. We have managers in our portfolio that source from YC, two specifically that I can think of. But they have very different strategies. And I think we would not want to have 10 managers in our portfolio that exclusively source from YC.
Fair point. And there's also something to say, there are too many managers, in my opinion, sourcing from YC Demo Day at this point. But there's a difference, just to pick on YC for a little longer. YC's great. Since we're on the topic, might as well talk about it. But there's a difference of someone going hey, we only invest in fintech, and they go to YC Demo Day for that. And there's someone else who goes, I only invest in healthcare, and I only I go to YC Demo Day. There's also a difference between I only invest in solo founders versus I only invest in co-founders. And yes, they technically can be sourcing from the same networks, but realistically, based on how laser focused they are on solo founders or specific attributes, their portfolio may not have that much overlap in the longer term.
Right. Yep, I agree. And I'm thinking of our two managers that source from YC. Both of them have done very, very well over a period of time. They are not really fun ones. They are more, they fall more into that camp of small fund, but more experience, more tenure, later kind of fund number. And they have very different strategies in terms of the types of companies they source from YC. And by the way, YC is a good pool to source from, especially if you get into the right deals, right? And so I don't look at that as a a concern that we have too much exposure to that ecosystem, right? And there are some ecosystems that you want more exposure to because they tend to produce a higher volume of really high quality companies. And I think that's okay.
I agree. All right, Chris is here now. I'm gonna let him out of the waiting room in just a sec. So we'll have our first caller in, Chris from Atria, as a GP to ask you questions. Chris, how you doing?
Hey, John. Hey, David. Sorry about the delay here. How's it going?
Now you're good. You're good.
Chris.
Thank you for joining in this experiment, and thank you for calling in for John and I. So, at a high level, I don't know. Have you guys met before?
I don't think we have. John, what firm are you from?
So I'm with Pattern. I think you've spoken to some of my partners before, but I joined more recently, so I don't think we've gotten the chance to meet yet.
I've talked to literally everyone in that firm. So yeah, yeah. I just saw Nico at a lunch 2 weeks ago or so in SF3.
Oh, cool.
Yeah. Awesome. Very cool.
Multiple touch points now. Now you have John as another touch point to Pattern.
That's amazing.
So for our listeners who are tuning in, who are not familiar with Atria, can you describe what is Atria? How did you get to it?
Okay, so Atria, we're a $25 million pre-seed fund. So we invest really early, inception stage rounds, first check-in, in AI and enabling infrastructure technologies in the life sciences. So the way we think about the world is there's a huge amount of biological change happening in the life sciences over the next 10 to 15, 20 years. And there's a lot of new technology that needs to be built to enable new therapies to come to market. So we invest across technologies and discovery and R&D, technologies that are supporting distribution or commercialization of therapies, and then we look at investing in data science and across life sciences.
Amazing. And you brought a question to us.
I did. So a debate that Dave and I have had multiple times, but I think there's an interesting moment happening in the market around solo GPs. We're seeing, I think, a lot of folks spin out from large firms, and we can kind of debate why that is and how that's being brought out. But also, there's a question of like the endurability of these firms and the brand amongst beyond the person. So the way I think about the world is like ultimately Atria is me. It is Chris Leiter. I'm a solo GP, and I intend to remain a solo GP. But often LPs want something that is a little bit more enduring after I decide to leave or close down Atria. And the way I think about it is I want to do 6, 7, 8 great funds and be a great LP someday. And I've talked to my LPs about that. Want to think, how do you see solo GPs expand and in terms of AUM and focus, and what are their limitations? But more importantly, can they actually build an enduring brand that is beyond them?
This is a really interesting question, and we back a lot of solo GPs, so we think about we think about this pretty often. And to your point, I think a lot of LPs think about this concept of like building an enduring brand, something that's lasting, something that's maybe can last beyond just a single person. But I think there's in a way an inherent contradiction when asking this question about a solo GP, because by definition, to your point, Chris, like Atria is Chris is Atria, right? A solo GP is by definition a single partner. So I think the entire brand being tied to that person, it's one and the same. It makes sense. So I guess my first question would be like how, and this is not to you, this is to the market, to LPs, like how would a solo GP create an enduring brand beyond themselves, right? If they bring on a team and partners and hire, by definition, they are no longer a solo GP, right? And so my next question would then be, do solo GPs need to create an enduring brand? And I think this is where it goes back to like LP philosophy, and a lot of LPs care about this concept of something that's long lasting. I think my answer is no. Solo GPs do not need to create a brand that survives beyond themselves. And I think there's a handful of folks who have operated as solo GPs for many, many years, sometimes many decades, over multiple fund cycles. Have stayed small, have done really, really well. And then when they decide they're done. And their firm, doesn't raise subsequent funds and it's over. I think of like, Tim Connors at Pivot North, right? Who raised small funds, every couple of years, did really, really well, and then stopped taking outside capital. And I think now, still invests maybe off his personal balance sheet. But, when he stopped raising funds, like Tim, Pivot North is not going to be a firm anymore. And like, that's okay. He did really well for a long period of time. And like, not everybody needs to create something that endures over multiple cycles and decades. I think a lot of LPs like to say they're very long-term focused and they want to find managers they back across, 5, 6, 7, 8 funds. I think in reality, a lot of LPs are fickle and allocator seats turn over and people change. And so I think there's a little bit of a disconnect between like LPs wanting to back funds forever and like them actually doing that. And so I think there's nothing wrong with backing a solo GP today at a point in time, knowing that, their strategy is really effective today. Like you're fully bought in today, but that in the future, you might decide like, I'm done raising funds, and that's okay. And you might have to find a new fund or a new strategy to reallocate that re-up capital to at some point. So, I mean, I don't think solo GPs need to create a brand that endures beyond themselves.
It's interesting because that first point is really interesting. You said it's like, okay, how do you actually classify solo GPs, right? Because there's also a world where as a solo GP, really just there's one person in the firm making investment decisions as you'd expect as a solo GP. But then the question is like, okay, are you hiring chief of staffs? Are you hiring 2 or 3 AAs to manage your inbox? And are you all these other AI tools, or do you have like 2 or 3 investment associates? And that's always like how's the flavor? And then I guess your second point is around this. I guess there are now we have examples of solo GPs who have shut down their fund and now that's off balance sheet. And I think the third point from what I'm hearing is like, look, LPs ultimately, like, I think there's this reigning zeitgeist that you have to be like, this multi-generational firm and all this other, and pass it on to the other people. And, ultimately I think that's very, very difficult. And there's a lot more partnership risk. And I think we've all seen the HBS case studies around, how difficult, and low digit percentage point it is to build a enduring decade venture fund that continually outperforms. Right. So there's my flip side, and this is a much longer conversation, but like, will we see solo GPs? Because I think it's still a new breed of manager. I would argue it's still fairly new. Is like, can they outperform over the long term?
Yeah. And I think the answer, I mean, look, it's case dependent, but like I think a lot of solo GPs can really outperform over the long term. And you said a couple things that I think are really interesting. One is, LPs talk about this enduring brand thing, but it's really hard to build an enduring brand. I mean, how many firms have really sustained a high quality brand, in perpetuity over like multi-decade long periods?
Very few.
Not a lot, right? I mean, even some of the firms that are the best brands today, like they've gone through periods of ups and downs, right? Kleiner had a period where like their brand atrophied for a period of time before Mamoon came in and like really turned the ship around, right? And so it's really hard to create something that sustains for a while. I think the other thing that you mentioned that's really interesting is a lot of people like to talk about the risk of a solo GP. I think there's actually more risk in partnerships.
I completely agree with you. Yeah.
With the solo GP, you know what you're getting, right? You're underwriting one person. You can be laser focused on them. Look, there's always the like if you get hit by a milk truck risk, but actually I think even that risk is overstated, because if that were to happen, God forbid, like the fund is going to, there are checks and balances in place for the fund to not like your LP capital is not going to be like
I never really
risk.
I mean, it sounds terrible to be a little morbid, but like as David knows, I do cycle a lot in the Bay Area, but I'm doing more gravel off-road biking, not on the roads, so that's like better. But but your point is like okay, there's an LPA and there's there's mechanisms to. So I kind of
totally
great. Okay, maybe you're halfway through fund deployment, like oh shit, but like you're not going to like
right, that would suck, but
you're going to lose your capital, right? But
exactly,
it's interesting. Yeah.
And the partnership, like I think, to my point about there being more risk in underwriting partnerships. I mean, we've seen, in the past 5 years, a bunch of partnerships have gone south, right? And I think there's actually more risk to the portfolio in a partnership that turns sour than there is in a solo GP, right? Because then like people are doing, there's bad investments, or like you're doing investments to spite your partner, and like the portfolio can, I think, take a really bad hit. And it's just really hard to underwrite new partnerships.
Yeah.
And I think people underestimate that. I think people think people LPs take comfort in the fact that there's more than one person, right? They view that as a safety net, but I view it kind of differently.
David, do I get a bonus question to ask John?
Of course. Just a little bit more time for a bonus one.
Okay, I'm excited. Okay, great. Because again, like this is something we're all seeing in the market. We've been seeing this accelerate, which is spin-outs from big firms. I kind of referenced it up front, but like, I'm so curious how LPs. I've heard multiple different vectors in like how you guys try to evaluate these spin-offs, because like the reigning thing I think about is like, okay, great, you're out on your own, but now you're finding that the GC brand actually helped you with deal flow. And now it doesn't, right? As an example, right? And like that's one thing, but there's got to be like 10 other factors that it's a very hard truth. I think that, and you could be like a star performer, but then I'm like, holy shit, like here's the deal sheet. Then and then you have to go into those deals and like, did that partner actually leave that deal at that 70 partner firm, right? It's got to be. I'm just like, the question is really like, how do you guys think about a pattern? And I think you guys have done some spin-outs if I know your portfolio, but like, how do you think about that? Or maybe you're actually negative on it. I'm curious.
We have fewer spin-outs in our portfolio vis-a-vis other I think LPs. And I think the conventional wisdom among a lot of LPs is like, oh, spin-outs are easier to underwrite because there's a brand, blah, blah. I think spin-outs are a lot harder to underwrite because
spicy.
It's a lot. Look, if you're at a big firm and you're a partner at a big firm, you've got your blinders on, you just invest. You don't have to manage a firm, you don't have to fundraise, you don't have to do this, you don't have to do that, you don't have to worry about building a brand. You have a brand, deal flow comes to you. Of course, like you have to work, to win good deals. But when you leave, you have to do all of those things and invest. And investing is probably a pretty small part of your time, all of a sudden. And I think it's really hard to know, like, who is able to be successful on their own versus like who was successful because of the brand that they worked at. The types of spinouts we want to back are the people who are successful in spite of working at the big brand, not because they worked at the big brand. But I think that's really hard to figure out. There's just become this almost expectation in the market now that like you do a few years at a big firm, you get that partner title. Which, by the way, there's been so much title inflation at these firms. Like everybody's a partner now. Like you get you get your partner title, you do a couple deals, get on a board seat or two, and then like you go out and do your own firm. And I think like that shouldn't be the base case. Like it should be, you need to earn the right to start a new firm and to do your own thing. And I don't think enough people realize that.
I want to test one really quick thing on this, which is something you just said. There's an argument to be made that if you actually build your career and you stay very long in these large firms, the psychology behind being a solo GP or spin out and staying in these large firms almost as a safety net to a certain extent doesn't suit somebody well to start a new firm on their own. Now, I'm making a big statement here, right? And it depends on like individual person, but like, I'm sure you come across these, you come in the first pitch and you're like, wait, hold on, this person, they belong, they should excel at a big firm. And they are not suited to do this on their own. And I think that's just like my situation all the time is like, okay, hey, I'm pretty good at screening, but there's sometimes days where I get on a call. I'm like, nope, this founder just should not be a founder. Like they should be, they should be a large product org inside OpenAI or something. They are not suited to do this on their own. I'm different equation, but like, there must be something to that also in terms of evaluation.
I think you're right.
Yeah,
I think you're totally right. Yeah, it's your analogy of, but like there are some people who are like big company corporate people who, by the way, excel in those environments. Totally. And then there are other people that like are really smart, but like, just can't do it in that kind of environment, like want to do something scrappier on their own. And I don't think one is better than the other inherently. It's just different. Right. And like, not, there are really smart people, great investors who can do well on their own, but not do well in a big firm and vice versa. Like that's okay. I just think it's important for those people to like have the self-awareness to recognize which camp they follow.
One last thing before we go, what color do we call the t-shirts we're all wearing?
I know. I think we're all wearing
we
very
cannot
similar.
coordinate this beforehand. Is it like
Sage? It's like a sage green.
Type of and it's like maybe like a mustard sage color green. I don't know, but
I think it's the color of the summer.
Yeah, I mean, clearly we're doing something right. I mean, the fashion industry has totally Red Pilled us. So yeah,
I guess so. Is this the new like tech bro?
Is it
color? I hope not.
I hope not as well. I want to be cognizant of time here, and in this beautiful unscripted T-shirt matchup, Chris, thank you so much for jumping on and sharing more.
Yeah, this was fun. Thanks, Chris.
I'm glad I've met another member of Pattern Ventures, which is great. It's so awesome.
Awesome.
Thanks, David.
Cool.
We'll see you soon.
See you soon. Bye bye.
I want to let our next caller in here, Arpan, as well, so we can just go back to back. People calling in. Arpan, what's up?
Hello,
hey, Arpan.
David. How are you?
I love the art piece behind you.
It's not mine. I'm house squatting until we move into our new house. So,
regardless,
is that Paris?
It is Paris. That is correct. It's my brother-in-law's background. So,
oh, John, you're good at this. Cool. I was still trying to guess. Like, do you guys ever play Geoguessr? Do you guys know what Geoguessr is?
No. What is that?
Yeah.
He said it so.
This is why.
Yeah.
I collect maps. I love maps.
Wow, that's awesome. I want to be a map collector too. It's an ambition.
I mean, my apartment's not big enough to collect more maps, but I've got a good number.
John, you're going to start a movement at some point. But for context, like Geoguessr is this like Google Maps API thing where they show you like a location and you're supposed to guess where in the world it is. And you're there are some people who get really, really granular on this, and there's some influencers who are really good. But that's neither here nor there.
Sounds like a data labeling business, like Skill AI for images or something.
Right.
Totally. This is like
it's a $30 billion business right there.
Jesus. Unbelievable.
Arpan, thank you so much for joining. I know you have a question for us, but at the same time, just to give our listeners some context as well, could you share what Garuda Ventures is and how you and Rishi started this?
Yeah, of course. So Garuda Ventures, pre-seed and seed lead firm, first check lead firm. We are based in the Bay Area. I was at Okta for 8 years before building Garuda with Rishi from pre-IPO days and beyond, early days through IPO. Rishi was at Scale and at Matrix, both trained in venture at those two shops, and then went on to operate as a first business hire at a couple companies, startups before we built Garuda. So yeah, we're a lead pre-seed focused mostly firm in helping founders get started on their journeys from kind of decking a dream all the way through. And that's us.
And you got to drop your own podcast. You guys have your own podcast as well.
We have a podcast. It's we did season 1 effectively. Brick by Brick is our podcast. It's been focused on operators, the early kind of glue folks, the first few hires, the folks that have those stories that make things work, and the lessons learned that aren't told enough. That's been an interesting area. We know those people. We have been those people in some ways, and so that's been our focus. And stay tuned for more on that front soon.
When's season 2 coming out? Can we do you heard it here first?
You're putting the pressure on. We're debating what the focus will be and when to come back for Fund II, but it's coming back.
Okay.
Yeah.
I'll be waiting. People will be waiting.
We should have you on. We should we've thought about, again, most of the focus has been operators for good reason. That's our DNA. That's what we come from. But gosh, there's so many good perspectives on what we do as an ecosystem represented, here on this call, the GPs, the LPs, the founders, of course, as well. So yeah, a lot of ways we can go with Brick by Brick.
All right. Well, let me know if I can help in any way. I know you brought a question to us.
Yes, sir.
What is this question that you want Mr. John Felix over here to talk about?
Yes, John is awesome. And thank you, John, for popping over here. Question I have for you, given where you sit, on the LP side, is kind of how often do you kind of know intuitively you're going to invest in a fund, let's say within the first 10 minutes, and then kind of use diligence to make sure, there are no gotchas, as opposed to kind of the opposite, which is building conviction as you step through a process over time. The The analogous question certainly exists for GPs as well, as we spend time with founders, but love to understand how you guys or you personally think about that on the LP side.
Yeah, it's a good question. So I think very rarely is there that like true love at first sight, like, in 10 minutes, like, okay, I am sold. Let's approve, like, we're going to make a commitment for sure. 100%. Right. It does happen, but it's extremely rare. Maybe once a year, right? Like maybe not even, which is probably like, that would be a fraction of 1% of the managers that we meet with. I think even then, when that happens, there are times when we're like, holy crap, that was amazing. We need to invest. But then we check ourselves afterwards, right? Like we take a step back and we do work and we end up not investing in some of those cases. So I think it's really easy to be emotional in the moment, and we're all humans and people at the end of the day. And by the way, a lot of VCs are good salespeople. And so I think it's important to check yourself and actually do the work. I think what's more common though is like, we have a great first meeting where there is an immediate connection to the manager. There's an immediate attraction. My partner Nico calls it magic, right? There's some sort of magic that we can easily spot, and we come out of the meeting and we think to ourselves, wow, like there's something special here. I want to spend time chasing this down and seeing if I can get to conviction. And I think that first reaction you have after an amazing first meeting isn't really conviction. It's a spark. But you need to let that fire burn to like see who can really withstand the heat, and then the conviction starts to come when you do the work. So or it doesn't come, right? The more work you do. And so I think very rarely is it like first 10 minutes like, I'm sold, I don't need to do anything else, we're in, show me the dotted line, I'll sign. It's just really hard. Like because everybody puts their best face forward on the first call, right? And like nobody's perfect, and so you need to spend the time to really validate that and figure it out. So, that being said, I think the converse of this question is like, how often do you know you're not going to invest in the first 10 minutes of a meeting? I think that's more common, and it's the unfortunate truth. But we do plenty of calls where we get on and we pretty quickly know like this is probably not a fit, or like I just don't think that this is something that we're ever going to be able to get conviction on. Yeah. We try to communicate that to the GP pretty quickly. Yeah. And look, in a perfect world, like that that intuition might not always be correct, right? Yep. In a perfect world, we would spend time doing deep diligence on every single manager we met with. But I'd love, as much as we'd love to do that, like we need to manage our time also. Yeah. And so like part of being a good investor and allocator is realizing, or at least like an 80-20 rule, like having the confidence, 80% of the confidence to say, this is not a fit. Like we just can't spend more time here. Or like, I think this could be a fit. Let's spend more time to really go deep and like try to build conviction.
Yeah, I think so many analogies, but not perfect, interestingly, to the GP landscape. I was just last night listening to Eric Vishria at Benchmark talk to Turner Novak at Banana Capital about a comment Eric made where he said kind of like some investors on the GP side, some investors kind of work from I'm leaned in first and then my partners or other work pulls me back, versus other GPs who are like skeptics by default and then have to be getting there. And so there's definitely some analogy to what you're saying. I'd say maybe one obvious difference when LPs are considering backing managers versus when GPs are considering backing founders is the time horizons are just so much longer, right? Like, I mean, we have to move much more quickly, even if we don't want to sometimes than you do. And so that sort of makes it easier to not have to commit. Although we as GPs know and have learned that pressure dynamics can work when you're raising with LPs too.
Yeah. And I think the reason why that timing dynamic is different, but also makes sense for company investing versus fund investing is like in company, a venture fund, when you invest in a bunch of companies, is very much driven by the power law, right? You expect to lose money, especially as a pre-seed investor, on probably half your investment or something, some like non-insignificant number. And all you need is one or two big winners to return your fund, right? And so you can make decisions quickly and hope that your kind of return profile will be driven by the power law. as a fund of funds, as an allocator, like if we lock, there's a sure the power law exists, but it's different in terms of fund return dispersion, right? If we make 20 commitments to funds out of our fund of funds, and if 50 of them went to zero, like that would be like that'd be like horrible, right? That'd be catastrophic.
Yeah.
If, by the way, if even one of our funds, lost money and returned less than a 1x, like we would be really upset about that.
Yeah.
So we're solving for different, company investing and manager allocation. Like I think it's solving for a little bit of a different things. And like, that's why the timing component, the decision-making component, I think is a little different.
Makes sense. Yeah.
Would it be a good way to describe it as GPs, more so like venture managers, are fighting for a strategy to win versus fund of funds are fighting for a strategy not to lose?
I don't love describing it that way because we're not in this business to not lose.
Right.
Exactly.
Right? We're in the business to win and hopefully win big.
Yep.
And so, I would be much more upset if we just not lost, than I would be happy if we really won, right? Like I think losing sucks more than winning is great. I mean, I want to win all the time, but it's a different dynamic.
What I would imagine, John, curious to hear your take on this, but imagine another dynamic as you think about just underwriting managers in general. I know we were talking about kind of first meeting reactions, but is, you meet a manager who's raising for fund two. You guys have that feeling that we got to do more work. There's something here. There's a spark, as you put it. Many, not all, and I actually don't know in Pattern's case, will back a manager for multiple funds. And so part of it is like, there's something here. Obviously, I want this next fund to be the one that's going to be a banger, but one of these funds is going to be a banger with these guys. And so if I get excited about the manager, independent from getting excited about the fund, because you don't necessarily know which fund will be the one that's the outlier fund of the 4 or 5 that you back for that team. Does that make sense?
Yeah. I think that does make sense. And I think that makes sense for venture investing, like in general. And I think that's why timing is such a hard thing to get right. And like, if you just consistently invest, across vintages, across a cycle, and you just pick, whether it's you picking good founders or me picking good managers, like hopefully the output should be commensurate with the input. But like, it's a lot harder to just be like, oh, I'm gonna only invest in this, fund, because I think like, in a way, if you're picking one fund, it's more of a timing bet. So I do agree with you. And when we back managers, we hope that we follow. We back them with the expectation and the hope that we can follow on in subsequent funds, assuming they do what they say they're going to do.
Right.
Don't screw anything up. Don't do anything unethical. Like do well. And so we always back managers with the idea that we'll try to support them in many funds after that.
Awesome. Cool.
I love it. I know we're coming up at time here. Arpan, thank you so much for jumping on and asking that question.
Of course.
And hopefully this is meant first of many more conversations between the two of you as well.
Yes.
Yeah, it's good to catch up. We should find some.
Yes, yeah, we've met and we have other connectivity with the awesome team at Pattern. So thank you for giving me another touch point with them, David.
I love it. Many more to come. Arpan, thank you so much. Thank you for jumping on this experiment. We'll talk soon.
Have a good Friday. Thanks, everyone.
See you. Take care.
Bye.
There's a lot of, like, going back to what Arpan mentioned earlier, right? Like, some people start from a yes and they eventually arrive at a no, right? And then some people start from a no and they're like, okay, let's build up conviction over time and we eventually get to a yes. I find that to be fascinating. And another example of just like, there are many ways to make decisions, obviously many ways to make money.
Totally. Yeah. I think about this a lot. And on your point about there's many ways to make money, that's why we are deliberately not dogmatic about like portfolio construction or strategy or GP background or this or that in what we look for. Like we take a pretty, other than drawing a line in the sand of fund size, we have a pretty wide aperture because I think there's a lot of ways to lose money in venture, but to your point, there are a lot of ways to make money and there are a lot of different strategies that can work. And what works really well for one person might not work well for another GP. And it doesn't mean they're right or wrong, right? It's like what works best for you. And that's what I think we're solving for a lot.
One of the things I've started thinking a lot more about, because as we're investing, I mean, this is true for like LPs investing in smaller funds, let's just say emerging managers, even though we talked earlier that you're not focused only on emerging managers, but it's also same as like GPs investing like pre-seed seed founders, more so pre-seed than seed, where you do have to rely on a lot of qualitative signals as opposed to quantitative signals. And we talk about intuition in our industry all the time. And I'm trying to find better ways to track my own intuition. And maybe even like that framework of trying to track intuition is foolhardy. But one of the things I found to be interesting for me, and this is too early to tell, is after every single meeting I have with a GP, I track, did I have more joy leaving the meeting than before the meeting, or less joy? And I literally just track like it's a binary thing: more joy, less joy, more joy, less joy. And if I have enough interactions with someone, usually minimum 2 to 3, and it's more joy every single time, there's something intuitively telling me that I should probably spend more time with this person.
I like that idea of trying to quantify your intuition, because I think it's easy to get scared by intuition and think like, oh, this is just, a whim, like, or how can I trust my own intuition? But I think intuition is typically informed by years or decades of pattern recognition. I think intuition is typically data driven, but not in the traditional sense, right? And so I think like if there's a way to take that raw output, which is an emotion, and translate it into something quantifiable, I like that, because I think intuition is something that investors should listen to. It's just hard to express sometimes.
It's scary also to rely on that, because when people ask you to write a memo or a report, it's hard to say like, I just intuitively know. Like in our modern world where we're so cerebral in nature, and like, whether it's earnings reports or just like, CEOs telling like, where are we going to go, a public company, where that's going to go. You can't just be like, I feel like this is going to be the direction. It's a scary thing to do. And I think as a human race, we might have over-rationalized a lot of things in our life.
Yeah. And look, sometimes you just meet with a GP or you meet with a company and you're like, you know what? Like, I know that this person's a killer. Yeah. And you just feel it, right? And now I can't go to my LPs and tell them every time, oh, every manager, like we just have a good gut sense about them, right? Totally. That's how we made our decision. So then you do your work and you find, quantifiable or other data-driven like points to help back up that intuition. But typically intuition, I think, is correct.
Before we let our next guest in, just to wrap up this thought, one of the folks that I've talked to, which I've deeply respected, David Hornick at Lobby Capital now. Obviously, their fund size is way past what Pattern would be investing in. But one thing he told me, he spends a lot of time in relying on intuition. It's like intuition decides whether you're going to it gets you like 80% of the way there. And it might not be the right like percentage breakdown. He might have said some other percentage, but it's directionally accurate. But discipline, aka doing the process, doing the homework, is finding out whether expectations meet reality. And that's a really important check that all investors should do.
Yeah, I agree with that. And that goes back to my point, about the question Arpan asked, which is like, how often in the first 10 minutes do you know? And, like I said, like sometimes in that first 10 minutes, you have a really deep intuition, like this is special. This is something I want to do. But then you go and do the work to justify it and to check yourself, right? Because we're all human, we're all emotional. And like, I agree with David, like intuition gets you, it can get you a good amount of the way there, but like you have to check yourself to an extent.
Totally. Because sometimes you're like, oh man, this guy or girl is amazing. And then they said they led 15, I'm making all these numbers up, like they led 15 deals at their last firm, and you actually do the work. And the person who actually won that deal was not them, but at another firm. The attribution just isn't there. But it's important to do your homework. All that to say.
Yeah, exactly. And then VCs are good salespeople. That goes back to I
know, they are really good. All right. Speaking of a VC, we have another caller in the room, which I'll let out of the proverbial waiting room over here. We have Ihar over here. Ihar, what's up?
Hi, great to see you guys. Thanks for inviting me, David. Hi, John. Yeah, I'm Ihar Mahaniok. I run Geek Ventures. We invest early stage pre-seed and seed in AI and robotics by immigrant founders. So I have a question for you, John. How do you evaluate Fund IIs, especially when the track record is basically Fund 1 with 0 DPI?
Yeah. So I get this question a lot. And I think when you're in the business of backing emerging funds or small funds, like you need to be comfortable with the lack of a track record. So that's the first thing that I would say. So then what do you care about? Like, what do we care about? How do we think about fund twos? I think there's two main things, specifically when looking at a fund two or a fund three. The first one is, did you do what you said you were going to do in fund one? So that's, everybody has a plan, right? Until they get punched in the face. But
Mike Tyson.
Everybody has a plan. And it's like, exactly. Did you execute on that plan, right? If you said you were going to try to get, write $1 million checks and get 10% ownership in these sectors, like, did you do that? Or did you do something very different, right? Because, as an LP, we're investing in a blind pool, right? We're making a bet on you. And if you did something different than what you said you were going to do, how can we back you again and underwrite something that might change a lot, right? So I think step one is, did you execute your strategy? And by the way, you can always make there's always going to be exceptions to your strategy, but like 80% to 90% of your portfolio should be very reflective of the vision and what you said you were going to do. So that's the first one. The second thing is there are ways to pick up signal of early potential success that aren't just markups, right? And so we can look at things like ARR growth in your companies. Maybe they haven't, maybe your company hasn't gone from seed to Series A yet, but maybe they've gone from 0 ARR to $800,000 of ARR in 3 months, right? Like that's a great signal. That's a great early signal. Maybe you've been able to co-invest with like really amazing co-investors, or maybe all of the companies that have raised follow-on capital have been led by, an amazing investor, right? So there's other ways to pick up on signal. We would never expect a fund two, or someone raising up, we would never expect their fund one to have DPI by that point, right? It's just too soon. And, but by the time you raise your fund, 4, maybe even your fund 3, like you probably should have some DPI. I think fund 3 might be tricky depending on timing, but when you're asking somebody to give you money for your fourth fund, like asking somebody to give you money for the fourth time, like you should probably have some liquidity. And it doesn't need to be an IPO or an acquisition. Maybe you took some chips off the table in a secondary transaction in a company that's done really well. So I think by fund 2, like sophisticated LPs are going to know that you're not going to have DPI. They're not going to care about your performance. A lot of the funds that we back have very little in the way of early performance or prior track record. So it's really about picking up signal on other things and really validating if you did what you said you were going to do.
Great, thank you very much. That's very helpful.
I love it. And to make that a little bit more granular of like, did you do what you said you were going to do? To follow up on Ihar's question here, what are the facets of what you're looking at? Obviously, you're probably looking at check size. You're looking at ownership targets that they initially set out. What are other like variables that you would look at to see if they did what they said they were going to do?
Yeah, I mean, if we backed a fund that we thought was going to be, an enterprise software fund, and they went out and deployed 40% of the fund into like crypto tokens, even if those investments did well, that would still be a red flag, because it's like, well, that was, you never told me that was going to be part of your strategy, right? So I think there's a bunch of facets of it. There's end sector or theme, or like whatever the types of companies you said you were going to invest in. Did you make the money, or did you make money the way that you said you were going to make money, or did you make money in like other random ways that you just got lucky? Yeah. The check size ownership thing is, it's something we look at, right? Like if you told me that you were going to, write X check size for X ownership and you did Y check size for Y ownership, like maybe that's a bad thing. Maybe you have a good story. Maybe pricing changed in the market and that's okay. But like you've got to be pretty close to what you said you're going to do. If you told me you were going to get 20% ownership in every deal and you only got 5, like that's a big delta, right? If you told me you were going to get 10% ownership and you only got 8 because seed round inflation got bigger or pricing inflation got bigger, maybe that's okay, right? But there's nuance to everything, but you just need to think about it a lot.
What happens, and in this same example that Ihar brought up of Fund 2 versus Fund 1, what happens when the key driver of MOIC, multiple on invested capital, happens to be a company that's external to the like thesis, but 90% of the investments were on thesis, or like 95% of the investments were on thesis?
This is a good question. And this is something that I struggle with sometimes because I think venture is a game of exceptions. Yeah. And I tell all of my managers, execute your strategy. Like 80 to 90% of what you do should be on strategy. But you should have a bucket to do opportunistic things that fall outside of your domain where, if you just see an amazing founder or an amazing deal and maybe it's a little bit outside your wheelhouse, but you should do the deal. It should be an exception, and you should not create a portfolio of exceptions. But that's okay. And I think if you have a good story around it and it's one deal, and you're like, hey, this was an exception, but here's why I did it. Here's why I got comfortable with it. I think that's okay. Now, if like that was the only deal that did well and like everything else on strategy like sucked, then you probably just got lucky, and like it's going to be hard to back your next fund, knowing that like your core strategy hasn't been that effective, and like maybe you're just getting lucky doing something.
Can I ask also a clarification? So I like you're saying like 80-90% on strategy, and then it's okay to make exceptions, because I'm also approaching that with exceptions. So in terms of ownership, what do you think about exception? Is from time to time, like signing an uncapped safe, let's say one per fund? Is it a reasonable thing? Or, because no ownership, obviously, right?
Yeah, look, I mean, in a vacuum, like I hate the concept of an uncapped safe, just because you're at the whim of the next tranche of capital, the next investor, and it's really hard to know. But if it's one deal and there's a good reason for it, and it's just an amazing founder or an amazing company, like that's okay, right? But it should be an exception, right? Don't do 20 uncapped safes, in your fund. One is fine. I don't, as long as it's an exception, I think that's fine.
What is the allowable percentage of exceptions in your mind, John? And I know this is different for every single LP out there, but is it 10%? Is it 20%? Is it one deal out of 50? Like, how are you thinking about it?
It's, there's you can think of it in like an 80-20 rule. I mean, 20% is probably high, but maybe it's somewhere between 10 and 20. Maybe it's a couple of deals a fund. If you do 50 deals, maybe, you can do a handful of deals that are off spec. I think once you get to more than that, then it becomes a core part of the portfolio. And like, it probably shouldn't be 20% every time. That being said, some people bake into their portfolio a carve out, an opportunistic carve out ahead of time. Right. So they'll say like, hey, I'm telling you right now, 80% of what I do is going to be in this swim lane, and 20% of what I do is going to be anything else. That at that point, it's like, okay, I know going into it that you're going to have 20% of your portfolio in something fun. But if you tell me today, like 100%, I am laser focused on, I am laser focused on this one theme, and 100% of my portfolio is going to be in that theme. And then, you invest your portfolio and like 20% is in something else crazy, then it starts to become a little uncomfortable. Now, those people should still be allowed to make exceptions, but you just need to manage your exceptions, and like, it has to be reasonable. Like, I'm not, there's no hard number that I have in my mind. Like, I think we're all reasonable people, and it just needs to make sense in the context of your fund.
So it sounds like, and I'm going to parrot this back to you and making sure I understand this right, because let's be honest, this podcast is my MBA to being an LP. So what it sounds like is you can make exceptions. 20% is probably the max if you're not explicitly saying that before. And if you do make exceptions, you should write a really, really granular case study every single time you make one, versus, usually when you go back to the market with a fund too, you go like, here's the select portfolio. And you kind of do like 2 or 3 case studies on random, well, maybe not random, but like some of your best outliers. But it sounds like if you are going to make exceptions, you should prepare ahead of hand to write really intensive, extensive also case studies on them.
I think that's right. I mean, look, it doesn't have to be like, like a McKinsey research paper, like a 100-page thing. But I think you should at least lay out your thinking, right? Because LPs will penalize an exception that goes south more than an on-thesis investment that goes south, right? Because you'll be like, hey, look, like, this exception you made was completely off spec and you lost money on it. Like, you should have never done that in the first place, right? But if ahead of time you lay out your thinking, the logic is sound and reasonable, even if that investment goes south, like, at least you had a framework that you used to make it. And like, I think that's okay.
I love it. All right. Ihar, thank you so much. Such a great question. So much more to chat about. Thank you for jumping on.
Thank you. Bye.
We'll see you around.
Okay.
The exception thing it's fascinating concept to me, both in the language of the word exception, but also how we think about exceptions and outliers in our industry. Because the truth is, venture is a world of exceptions. Like, we only invest in exceptions. Compared to the grander scheme of, financially driven asset classes, right? And we are driven by the power law as well, whereas a lot of other industries are normally distributed. And so I think a lot about it, but to make an exception for investing in exceptions already, I wonder how many degrees of freedom that as investors we're allowing for let's say GPs to be able to do so. Yeah.
And by the way, I am not saying that that my viewpoint is the right viewpoint. It's my viewpoint, right? And everybody's got different perspectives, and I don't think it makes any of them inherently right or wrong. Yeah. And there are good exceptions and there are bad exceptions. And sometimes at the time of decision making, and sometimes you don't know until a lot later.
It's fair. How would you, to piggyback on that, obviously hindsight bias, but are there other things that you use to define a good exception versus a bad exception?
A bad exception would be there's a deal that's getting done and it's moving really quickly and Sequoia is leading it. Like, that's all I need to know. And like, I have the opportunity to invest. So like, man, tells a good story. Like, I'm going to write a check, right? Even if it's off spec. Like, that's a bad exception when like you're effectively borrowing conviction based on a brand name, right? A good exception would be, I've known this founder for 10 years. She's exceptional. She falls outside of my swim lane, but I have an unfair advantage because I know her and I know what she's capable of and she's amazing. And even though she falls outside of my thesis, I want to make a bet on her. Yeah. That's like a sound decision-making, type of exception.
This actually reminds me of something. I backed a manager recently, and he was at a cross point at one point, like a crossroads, and he had two deals he could have invested in, which were clearly off thesis, right? It wasn't the valuation that he had pitched to us, or like the target valuations he was pitching to us. He wouldn't get the ownership targets in which he was pitching us as well. And he one of the beautiful things is he also writes weekly emails, which I'm just very impressed that the weekly updates come in as consistently as they do. But all that to say, he wrote this in a weekly update, and he said, I have these two deals I could do. I've known these founders for a very long time. They're clearly world-class performers. And in many ways, these are folks who would fight to get in this round. And here's the opportunity. Here's who else is participating, but I've known them for even before they became a founder. Should I do this deal? Can I gauge feedback? Here are the pros and cons of doing each deal. And he kind of like polled the LPs of like, should I do these things? And all of us, or not all of us, but a lot of us gave kind of feedback of should you not, or maybe like, instead of should you or should you not, it's like, here are the things you should use to think about things. Right. Is this something you're willing to risk your reputation on? All that kind of stuff. And then he didn't do either of those deals. And the primary reason is, you paid me to invest the strategy. This is not the strategy I pitched you. And so, although I love these two individuals, I chose not to do it. And I don't know, at least for me, that gave me more conviction in the manager than even before I invested. I already had a lot.
I appreciate that. And I would say we are paying a manager, yes, to execute their strategy, but really what we're paying them for is to hopefully make us a lot of money.
Totally.
Right. And I think, given that venture's a game of exceptions, like they should do their strategy most of the time and overwhelmingly most of the time. Right. But occasionally, I think at least occasionally, GP should make good exceptions. When the decision-making is good, the logic makes sense. Doesn't mean it's going to turn out, to be an amazing investment, but there has to be a reason and logic behind why the exception makes sense.
Totally. I mean, I think for one of those investments, it was clearly just someone who was a high caliber individual, but their company was pre-revenue. I want to say this was like they didn't even ship out the first product yet, and they were raising on $100 million post.
Yeah, that's tough.
And so he was like, clearly, this is someone that had this been even like a 20 mil, maybe even a 30 mil valuation, I would have easily jumped in on. But at 100 posts, that stretches things way too much. So he didn't end up doing that.
So right. And so like maybe that would have been a good exception to make it at a 30 post or a 20 post or whatever it is, but maybe it was a bad exception to make it 100 post, which is why he didn't. Right. So there's nuance to all of this.
I agree. So we're going to wrap this up. And I'm so glad the three of our callers called in, Chris, Arpan, as well as Ihar. Maybe as one last question to you. And to be fair, I've changed this question a couple of times, but there's this quote I've recently, let's say, been re-fascinated with. And it's this quote from The Office where they say, I wish there was a way to know you're in the good old days before you've actually left them. And with all the doom and gloom around us today, what are reminders to you, John, that you keep close to your heart that remind you that we are in the good old days?
If you look throughout history, there have always been periods of time when humanity thought that the world was ending. This happens all the time throughout humanity, right? The reality is people are living longer than ever. People are healthier than ever. Like we're curing, bad diseases at a rate faster than ever. Medicine is better than it's ever been. And of course, there are plenty of problems with our healthcare system. Like people are, worry about safety in big cities. We are living in the safest period of time in human history. And so I just think it's important to contextualize things, to put things into perspective. And, it's easy to be all doom and gloom. And believe me, like I'm a news junkie, and if it's easy to pull up the newspaper every morning and get depressed immediately, but you have to put things into perspective, and I think perspective makes you realize that we've all got a lot to be grateful for, and we're all very fortunate to be living in 2025 versus the year 25.
I love it. Is there anything else as we close things out in the curtain call and we land our plane? Is there anything else you would like to leave with our listeners? The allocators listening, the GPs listening, anything else?
No, I think, maybe the only thing I would say is, in a way, adding to the point of exceptions, like growing up in the allocator space, earlier on in my career, when you're first learning, you try to learn all these frameworks and you try to learn how things have been done successfully throughout history, but sometimes things don't always fit neatly into a framework or fit neatly into a box. And I think part of being a good investor is just keeping an open mind, right? Especially in the context of a multi-manager. So I would just encourage my peers and my friends who are also allocators to just, keep an open mind and realize that there are a lot of ways to make money in this business, and what worked 10 or 20 years ago might not work in the future. And so I think it's incumbent upon all of us to just always keep an open mind, always make sure our thinking is evolving, and to keep up with the good old times.
Freaking love it. John, I appreciate you as always. You're awesome.
You too, David.
All right.
Thanks, man. Appreciate it. It's always fun.
All right, Superclusters. We'll talk soon. Let me know down in the comments or on socials if we should do more of these. Hope you enjoyed today's episode with the one and only John. I highly recommend checking out our earlier episode on Superclusters. In fact, here's one of my favorite moments from our episode in season 3.
I think, look, a lot of endowments say that they like concentration, both in terms of number of line items, on the for the total endowment, but also in terms of portfolios for each of those managers. I think in reality, manager proliferation happens at almost every institution. And part of that is because, if a CIO is there for long enough, there's re-ups, they like to do new things every year. It gets really hard to fire existing managers. And so you end up just adding new managers. And so what we did, the first exercise we did when Scott joined was every asset class team force ranked every single manager in their portfolio. And it was a forcing mechanism. It's like, you can't cop out and say like, oh, well, these are our 3 favorite. It's like, no, you have to rank them 1 to 3. And by the way, you have to rank every single manager 1 to, however many managers are, right? And so
gotcha.
That ruthless
to interject
force,
here, is this also like let's say it's a team of 2 managers, are you ranking them separately, or are they just a single institution?
Well, so I guess what I meant is, like, for example, the public equity team ranked all of their public equity managers, force ranking. The private equity team ranked all of theirs independently. And so each asset class had its own force ranking. Gotcha. But the idea was that, like, if a manager wasn't your top, 5 or top 10 idea, why is it in the portfolio? Right. And so what we did then is we looked at that and it almost forced you to say, like, hey, you rank this manager number 20 out of 20. Why haven't you fired them by now? Right? Why haven't you redeemed your capital? Right. And so we ended up culling the manager roster meaningfully and concentrating capital either into the top existing ideas or in some cases adding a couple, new managers.
Let's say you decide someone ranks 20 out of 20. How do you have that conversation with the manager? Or do you kind of just expect the manager will follow up the next time they fundraise and you're like, unfortunately, we can't invest in you? Or is there a proactive, preemptive communication tool you use to tell the managers, like, hey, you know what? We're likely not going to re-up in you for the next fund.
There's the proactive communication, which I think we did in some cases and which I'm a fan of, because look, I think at the end of the day, the real managers that have integrity, they would do the same for their portfolio, right? If one of their companies was raising a follow-on round, they didn't think it was a good investment, they wouldn't invest. And so if you kind of be proactive with that communication, I think it builds long-term trust that doesn't kind of burn the relationship. But in some cases, you also have to look at your cost of capital and the opportunity cost and think, is keeping my dollars with this manager today a good use of capital, or is something like a secondary sale a better use of time and capital, right? And so in some cases, you can use tricks to actually even kind of redeem your capital sooner than maybe you would have expected or kind of otherwise would be able to. And those kind of situations were only reserved where, you had really kind of lost confidence in managers. But I think it's important to just be communicative with managers in general. And I've found that the managers with integrity and that are ethical, they appreciate that communication, even if the answer is not what they're ultimately looking for.
In the process of like stack ranking all your managers, was it largely returns driven? So like you were ranking like, hey, you know what, like here's the consistency of returns across 5 funds seems to all hover around 5x, and that's why we were continuing double down. This one, there's too much variability in their returns, and there's a 2x fund here, and then there's a 20x fund here, but it's just way too risky for us. Or is it more so like industry focused, team building, like roughly? If you can leave it to speculation if you want, but like, how did you rank the managers? What was the rubric?
Yeah, I mean, naturally a lot of performance had a big part in it, but there were also things like alignment with investment philosophy and alignment with broader endowment portfolio construction, and so things like more diversified portfolios or portfolios that started to look like indices would rank lower, even if their performance was higher. So we had a couple managers that had, I would call them almost like enhanced index strategies or like smart beta kind of strategies, where maybe they had really good performance and outperformed by, their benchmark by a couple hundred basis points every year consistently. But because that didn't really add anything to our portfolio, something like that would have stack ranked much lower than maybe a concentrated portfolio that had maybe a little, maybe its performance wasn't as great, but it had a higher potential to generate outperformance over the long term.
Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are 2 small things. 1, there's a little red subscribe button down there if you're on YouTube, and a follow button if you're on Spotify or Apple Podcasts. If and only if you enjoyed today's episode, that's the button to click. You'll get many more presents, many more insights, and many more brilliant minds straight through the internet vines just like this one very, very soon. 2, it'd mean a lot to me if you could share it with one other friend who could gain a lot from listening to today's Cosmos of Insights. Also, let me know if there's anything I should have asked down in the comments, and if there's enough interest, we'll have today's guest back for an even spicier part dose. I made a promise to myself to record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more helpful and fun for you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I wanted to share a quick disclaimer. The views expressed in this podcast are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we're a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. I'll see you on the next.